Great. So I think we'll just begin this session and good morning and a very warm welcome to all the panelists as well as the delegates who have joined us for today's webinar. I think it's almost 23 hours the speech got over, and a lot of people must have absorbed a lot of things through various debates on TV channels and many other resources. But we will still try to see that if there are any other confusion left, probably we can try to address them here. And that's why we have a very eminent panelist with us of economists and tax experts with us. And From a FICCI perspective, our leadership has called the budget inclusive with trust on quality, job creation, skilling, and the budget which strikes a balance between agriculture and manufacturing with elements of services. So that's what we have. Our leadership has been talking about, and they have been on various discussion forums since yesterday, talking about where budget strikes well and where it could have improved, and we can share those links as well in case someone wants to know in detail about that. So with this today's session, we will be having two talks, primarily first on the taxation side, and the second one is on the overall macroeconomic impact of the budget. And we have with us two eminent, panelists with us for this particular part. And followed by, we will break into a panel discussion mode where we can generally largely talk about the overall economic, impact and what would be the long-term, outcome of budget proposals. So with that note, let me invite our member Lokesh Chaturvedi ji just to introduce our first speaker, Mr. Nihar Jambusaria, and then ask him to, give his speech. So, Mr. Chaturvedi.
Thank you, Deepak ji. And it's a privilege to introduce a person like Mr. Nihar Jambusaria. He's a very well-known figure in the professional circles, and Mr. Jambusaria has been in practice and industry for nearly 40 years, ever since he qualified in 1984. And after retiring from Reliance Industries as Senior Vice President, he has founded NAMA Advisors, which is providing consultancy to organizations in the private and public sector in the areas of direct tax, international tax, mergers, acquisitions, FEMA, restructuring of business, family office, and estate planning. As president of the Institute of Chartered Accountants of India, Mr. Jambusaria has represented on the International Integrated Reporting Council in 21-22. He was also president of the South Asian Federation of Accountants for the year 23. I think over 40 years, he has so many distinguished accomplishments that it is difficult to, recount. We welcome him on this forum, and we look forward to his views. Thank you very much.
Thank you, Lokesh ji, for the introduction. All the speakers on the panel and those who are listening to this analysis by the eminent personalities other than me. I'm only confining my talk to the direct tax, but there are economists who can view the long-term impact of the budget and talk about it. Let me thank FICCI for giving this opportunity of presenting views on particularly the finance bill, the direct tax amendments. Now, if we look at the overall changes that have been made, like every year, good number of changes have been made in the existing provisions of the Income Tax Act. The rates of taxes have also been changed, amended to some extent. There is not very big impact of change in the rates of taxes, but then one can expect that stability in rates was aimed by the government, and particularly they want to cover a larger population to be within the ambit of tax regimes. So with that, I think let me deal with some of the very major amendments. As there are large number of amendments, it will not be possible to deal with each and every amendment, but those which are very impactful, significant, and requires thorough understanding of what will be the impact, I will try to cover in the time that is allotted to me. So first, if we look at the rates of taxes, and I'm not making the presentation to have the attention of the participants. Then for domestic companies, those who have opted for the new tax regime, along with all cesses, the rate of tax will be 25.168%. For domestic companies with manufacturing activity, if the manufacturing activity was started between 1st October 19 and 31st March 24, then the rate of tax will continue to be 17.18%. For those companies which have not opted for the new regime, for them under the old regime, if their turnover doesn't exceed 400 crores of rupees, the rate of tax will be 29.12%. And if their turnover exceeds 400 crore, then the rate of tax will be 34.944%. Now, these are the rates which are existing. Now, from those companies which have not opted for the new regime, they have certainly done so because for long period they are expecting that they will be covered by MAT, because no company would opt for paying higher tax when the concessional optional tax regime is available. So very few companies have opted for old regime where they are expecting their MAT liability will govern their tax liability. And under the old regime at the rate of 17.472%, they are better off than completely going out of the book profit MAT regime and going for the new regime and paying higher tax at 25%. So this is for companies. For foreign companies, the rate of tax has been reduced from 40 to 35%. Now, if we come to individuals, under the old regime, the rates of tax are the same. Under the new regime, they have amended the limits, although the overall 30% rate commences from 15 lakhs only, but up to 15 lakhs, the slabs are so arranged that there is some reduction in the rate of tax, in the total tax payable. So from up to 3 lakhs, now there will be no tax. From 3 to 7 lakhs, it will be 5%. From 7 to 10 lakhs, it will be 10%. From 10 to 12 lakhs, it will be 15%. From 12 to 15 lakhs, it will be 20%. So the slabs are many, 5, 10, 15, 20. But in the new slab rates, there will be a gain of about 17,500 rupees. And those whose income does not exceed 7 lakhs and they opt for new regime, they will continue to get a rebate under Section 87A, which was allowed up to last year. It is continued. The limit of rebate was 25,000 rupees. They have not amended this limit, but under the new slab rates, the total tax payable itself will be 20,000. So rebate will also be 20,000. There won't be any refund, although the maximum rebate allowable is 25,000, but rebate is always allowed with reference to the tax payable. So up to 7 lakhs, if exactly 7 lakhs is the uh, income declared by an SSC at 5% from 3 lakhs to 7 lakhs, it will come to 20,000 and full amount will be eligible for rebate. But once your income exceeds 7 lakhs, this rebate is not allowable and then the person will pay tax at these slab rates. Another very significant amendment is in the standard deduction. from 50,000 rupees, this limit has been raised to, or is sought to be raised to 75,000, but subject to the condition that the employee opts for new regime. Now, this indicates that the government wants taxpayers to adopt the new regime and eventually completely weed out the deductions and exemptions which are available at present. And the finance minister has indicated that in 6 months' time, they may come with a new code. So I think the indication is that in the new code, perhaps these deductions and exemptions may be completely done away with, and the rates of taxes may be calibrated accordingly. Now, so far as surcharge is concerned, again, what is important is above 50 lakhs, surcharge is applicable at 10% up to 1 crore. And from 1 crore to 2 crore, it is 15%. 2 to 5 crores, it is 20%, sorry, 25%. And above 5 crores, it is 37%. The old concession continues that if your income consists of dividends or long-term capital gains covered under Section 111A, that is listed securities on which you have earned long-term capital gain, then on those incomes, whatever tax is payable will be subject to surcharge only at 15%. And those who have opted for new regime, for them 37% surcharge will not apply. Their maximum surcharge will be capped at 25%. So that is the relief in surcharge also given under the new regime. Now, if we look at rationalization measures which have been taken, then in capital gains, there are significant amendments. On listed securities, on short-term capital gains, so far the taxpayer was paying tax at 15%. Now the new rate will be 20%, and this applies with immediate effect. So all transactions done yesterday and which will be done today and onwards, they will all be subject to the new tax regime, and short-term capital gains will be taxable at 20%, and the gain is long-term. It will be taxable at 12.5% on listed shares or units of equity-oriented funds. For even listed units of REITs and InvITs, that is business trusts. Now here, there was a knee-jerk reaction yesterday and the market fell. But I think perhaps this measure has been taken to ensure that funds which are invested by the general public are divided between equity and deposits. We have seen even the RBI governor complaining that the deposits are falling in the banks. So probably to bring back that liquidity for banks, this step may have been taken. We have also seen that yesterday there was announcement in the increase in the STT, that is security transaction tax. And this was on options and futures. From 0.062%, it has gone up to 0.1% and so on. But again, this increase appears to be on account of the latest trend of people getting indulged into options and futures. Even SEBI has reduced the time limit available for settling the options and future contracts from 15 days to 1 day. So all these indications are, all these amendments are showing indications of being disciplined when one enters into this kind of transactions. Now, again, on capital gain, there are some amendments which are very important, like listed securities other than units or zero coupon bonds. For them, the long-term, for being long-term, the time limit is more than 12 months. It continues to be more than 12 months. And the rate of tax from 10%, it has been increased to 12.5%. On unlisted debentures and bonds, the long-term limit of 36 months has been reduced to 24 months. And for market-linked debentures and debt mutual funds also, the 36 months limit has been now reduced to 24 months. So the benefit of long-term capital gain will be available after 24 months. And now there are only two limits. For listed securities, 12 months. For other assets, it will be 24 months. So 36 months time limit has gone. And for other assets also, the time limit of 36 months for being long term has been reduced to 24 months. But there, the indexation benefit has been withdrawn. And the rate of tax from 20% with indexation, it has come down to 12.5% without indexation. Now, here one may make the calculation and one may logically understand that if we take example of a property which is being sold now, so with indexation, whether 20% is beneficial or without indexation, 12.5%, that one may see and compare. But by and large, I think certain benefits which were available, they are all being made subject to flat rates of tax, and other benefits are withdrawn and tax rates are being calibrated. So from 20%, it has been brought to 12.5%. Those who were holding old properties for a long time, they may feel the pinch of withdrawal of indexation benefit, but those who hold properties not for very long time, 12.5% rate may be more beneficial. So it depends, and it will vary from person to person. Another important amendment is abolition of angel tax. The tax which was levied under section 56 subsection 2 clause 7b, where a company used to issue equity shares at premium, that is at more than face value. The amount taken as premium, which is beyond the market value, was regarded as income from other sources, and the company had to pay tax on it. This was called angel tax. This is being withdrawn, and if you go through the explanatory memorandum, the objective seems to be to encourage startups and new companies, and where they are getting better value, they are not at the first stage asked to pay angel tax. And this is a very welcome amendment, because many times even determination of fair market value for unlisted shares had been a matter of dispute with the department. So with abolition of angel tax, I think even that kind of dispute will no longer survive. Then equalization levy, again a very welcome step on e-commerce supply or services, which was leviable at 2%, is being withdrawn. Now, it was expected that perhaps in this budget, the government may introduce Pillar 2 provisions, taxability, where you have even existence in terms of marketing, etc. Now, Pillar 2 has not so far been introduced, but probably when the new code comes up, say within 6 months, it may get introduced. It was the intention to have Pillar 2 in place if you see so many announcements of CBDT and ministry in the past. Now, again, tax on buyback undergoes change and the old regime starts now, but it is in a new format. We know that when a company used to buy back the shares, company was supposed to pay tax on it. And now a shareholder who offers the shares for buyback will pay tax. The entire amount of receipt by the shareholder will be treated as dividend, and accordingly, under income from other sources, the shareholder will be required to pay tax. But at the same time, the cost that he incurred to buy those shares, it will be treated as capital loss, short term or long term, depending on the period of holding before the buyback. And it will be allowed to be set off against either long-term or short-term capital gain. So this is the way it will be taxed. And here, perhaps the shareholder will not be at advantage, particularly those who are in the highest tax slab. This dividend would be taxable at the highest rate of tax. Then another very important amendment is that in the case of ESOPs, under Section 17, it is regarded as perquisite. The fair market value of the share is reduced by the price that the employee pays for those shares. The difference between the two was treated as perquisite. And even now it is treated as perquisite and it is taxable. But here, some employees claimed that this is gift by company to the employee, and therefore it should be covered by Section 47, Clause 3, which exempts gift. If gift is given, it is exempted. Now it is being clarified that Section 47, Clause 3 will apply only to gifts and HUFs, because gift out of love and affection is sought to be exempt. And a corporate cannot gift to an employee out of love and affection. So now only gift by individuals and HUFs will be exempted. And what an employee was earlier trying to claim, and those cases are in dispute and in appeal, that dispute will not arise anymore. So it will not be treated as gift. Again, when a person let out his residential property to somebody, many times the owner of the residential property used to claim the income as income from business. And we know that when it is claimed as income from business, a number of deductions one can claim easily. But again, the concept with the government is that when you own a residential flat, generally it is not that you are engaged in the business of owning such properties and letting them out. So now it is being clarified that any rental income from such residential property will be treated as income from house property and it will be taxed accordingly. Again, some of the significant provisions are for search and seizure cases, they are reintroducing the block concept. For 6 preceding years, the income can be taxed. Now, if the search happens after 1st September 24. Another amendment is in reassessment provisions. And very briefly, I will tell you that in 2021, they introduced amendment that a case can be reopened up to 10 years back if the income expected to be escaping assessment exceeds 50 lakhs. Now this time limit of 10 years is being reduced to just 5 years. And it is being done rightly so for up to 10 years. It was a long period and one may not have even records to prove whether the income escaped assessment. So a right step has been taken by reducing this period of 10 years to just 5 years.
And
Again,
sir, if the income is below 50, then it is 3 years from the end of assessment
then it
year.
is only 3 years. Then the time limit is the same. For below 50 lakhs, the time limit is even earlier, it was not 10 years, it was 3 years. It continues to be 3 years. Only if it is above 50 lakhs, then 10 to 5 years. That is the only change. Then now a CIT appeals can set aside cases which are passed under Section 144 and a very specific provision is being made. I am not discussing this in more detail, but one may go through this provision. This is beneficial.
Yeah, that's true because we also have time limits. So,
Yeah, that is why. And I will just wind up in 1 minute. Safe harbor rules are sought to be expanded. Transfer pricing being subjective, the government realized that the demand for expanding safe harbor beyond the percentage limits which are set at present was much required, and it is being brought now, and one may go through those provisions which are done in detail. Now, in another half a minute, the TDS rates are being calibrated. See, there was difference, 5% rate for commission, brokerage, and other incomes, and 2% for certain income. And certain taxpayers were claiming my payment is covered under 2%. I have made payment to contractor. Whereas the department used to claim, no, it is brokerage or it is professional fees. Now they are calibrating rates at 2% for so many categories of payment. Avoid disputes in future, and the government's object of bringing those payments within the fold of income tax is getting achieved. Whether tax is deducted at 5% or 2%, that income gets reflected in 26 AS, and government or the tax department can follow up and find out whether such income is offered for tax. TCS now will be allowed to be deducted while deducting TDS in the case of employees when they buy a car or a valuable property. Earlier, it was TCS was confined to motor car about 10 lakhs. Now they are going to notify a number of other luxurious items. If the cost is about 10 lakhs, TCS will be collected by the seller. And lastly, I would say that uh, there is rationalization in the tax regime for charitable trusts. Three amendments to be just listed is that now again the registration under first regime and second regime, that is 1023C and 11, that distinction is being removed. For future, registration will be done under second regime only. Now when two trusts merge, it will not be regarded as exit of the trust which merges with another trust. Otherwise, there was accredited tax on exit from the charitable activity. And thirdly, where registration has not been granted because of delayed application, there now the commissioner is given power to condone delay and register. Because if the trust is not registered, it would be deemed to have exited from charitable activities, and the exit tax was very exorbitant. So now with this power being given to the commissioner, he will judge situation, and in appropriate situations, trusts delay in application will be condoned. There are some other amendments. If during panel discussion we can deal with them, we will deal with them. But I think these were major amendments which would impact a common person or a normal corporate. And I once again thank Vicky for giving me this opportunity of dealing with some of the direct tax provisions today. Thank you.
Thank you, sir. Thank you for the great insights coming from you. And I think the great part of the budget was talking about simplification of the direct tax. And it remains to be seen what kind of simplification comes over next 6 months. And a good move towards FDI and the reduction of tax in foreign investor. I spoke to some foreign investors yesterday, and they take it very positively. And also decriminalizing certain activities. I think that's a very welcome move. Thank you very much. I hand it over to Mr. Deepak.
Thank you, both of you, for giving us. I know there were so many amendments and tinkering. Actually, that this time is not enough. But unfortunately, this is the first time we shortened the time of text presentation, and then a lot of challenge, changes, came. But we'll try to see what better we can do. Now, let me move on to our next presentation, a brief presentation by Dr. Shukla, before we move it to the panel discussion mode. So over to you, Dr. Shukla.
Thank you, Deepak. I think in the interest of timeliness, let's probably move on to the panel, because anyways we are going to be discussing more or less similar things, and it will also do justice to all our panelists and people on this call. So if you don't mind, I think
sure, no problem. So then I will hand it over to Kumar from the Financial Express to moderate this session. Over to you, Kumar.
Yeah, hi. Thank you, Deepak, and good day, everyone. Actually, very good morning. Thank you so much, Niharji, for that incredibly nice and succinct presentation on the key issues which are there. The one thing which runs across is the whole question in terms of really, is there a genuine move towards simplification? One question which people had was yesterday on buyback tax, for example, is being treated at the to the recipient is a fair thing because one who's benefited is paying the tax. But to be treated as a dividend income is a higher tax compared to capital gains. So will there be an incentive for person to give it back to the company? I mean, how does it simplify? A very brief comment on that before I get to the general observations about the budget.
So, anybody else would like to comment on this, or?
Yeah, maybe I can make a comment.
Yeah.
So see, simplification is a process and it doesn't happen overnight. So as the finance minister said, they will take about 6 months. So I think they will start now and over a period of time they will come. So it requires a comprehensive review of the tax law and not just looking at one or two provisions here and there. So currently, as an interim measure, they have made some announcements which could be immediately effective. It doesn't simplify the whole thing, but the simplification is a different process altogether, which will be a comprehensive thing. So as of now, we have to deal with each individual change.
So for the time being, I would just take a minute to just supplement what Lokesh ji said. That so far what we have observed is generally some provision is introduced, it is withdrawn later, or old regime is brought back. So that kind of scenario, when the government considers the entire overhaul of the act, we expect that major provisions will be for long term so that people can apply those provisions and comfortably plan their taxes and the affairs in the future. So, with the new regime that they are planning, let us expect that there will be such long-term approach of the government on the tax provisions.
Yeah, I understand.
I
No, my
can add.
question was only whether the dividend income is tax as dividend income is higher, capital gains is lower. So that was the question. I mean,
Yeah.
so I thought
Yeah,
maybe because Mr.
I
K.K.
can-
Misri, yesterday I was speaking to him, he was saying that if it's treated as capital gains is better rather than a dividend income. So I wanted to just, anyway, my question to overall, just for the interest of time, what do you, from the tax measures and some of the policy thrusts which have been announced, what do you see as the overarching message to the corporates and to the individual? Does it, in the sense, incentivize industry to think in terms of flowing back, investing more, and from a taxpayer's perspective, the individual to save more and spend more? Is there an underlying message on that? If we can at least get a broad sense from the esteemed speakers we have here. Starting with anyone who would be okay.
Do you want me to start? This is Sunil.
Yes, perfectly. That will be nice. Thank
I
you.
can talk from the capital markets perspective. And before that, let me just also add my 2 bits on, I know the tax is evergreen and Deepak made a mistake of cutting down the time. We all know that tax is always a very important topic. Just coming on the dividend tax, see the issue there, which is being always debated for many, many years, that of the double taxation. What is happening here? The corporate earns the profit and they pay tax, and then you distribute that profit, and again the recipient pays tax. Right? This view was taken way back by Yashwant Sinha to say, look, if the dividend is treated as an income, it should be taxed in the hands of. Before that, the dividend had a minimum deduction, etc. If you go back in the history, and since then this regime has been changing. During 2007 budget of Mr. Chidambaram, he simplified it to say the corporate will pay tax and the dividend will be tax-free in the hands of the recipient. And that actually made the life quite simple. And then again, we brought the dividend tax back. Buyback was exactly the similar. It's also distribution of the profit. And that's what the explanatory statement of the finance bill, which you read, this is what it says. On buyback, we still kept the old dividend provision, which is the corporate will pay tax. And therefore, a lot of large corporates who wanted to put money back into the hands of the investor, they would actually use the buyback as a method. And that was much more tax efficient way. Now they have tried to plug that. Now, while when you change the regime, there are the side effects also of this. The buyback will be taxed in the hands of the investor. But when I bought the shares, I would have paid for it. Now that gets set off as a capital loss for me. I should have the capital gain, and plus that set off gets that set off is at a lower rate than the tax which I pay. So that's the problem. So to my mind, purely from the capital markets perspective, buyback is a history. We will not see corporates actually going for the buyback. So this is just on the continuation of the question which you had asked earlier. In terms of how do we see the budget purely from the corporate and the investment mindset, I think there is one silver lining, and which has been the hallmark of this government earlier also in the last 10 years, and the previous BJP regime is to be fiscally very disciplined. Despite the political constraint and despite the mandate, during the interim budget, and even now they have been fiscally very disciplined. We have a renowned economist, they would vouch for it. The fiscal deficit cutting down from 5.1 to 4.9, which was just in February, they actually announced 5.1. And now the new number, obviously the benefit came from Reserve Bank of India, but 4.9 was a positive move. What it will do is it will eventually help the rating, the improvement of the credit rating of the country, sovereign rating of the country. Just to give you one example, and I'll close there. If you see our rating versus one notch above global rating, we are at BBB, which is the minimum.
minus, isn't it?
Yeah, BBB. So, and BBB plus, if you see, for example, Italy is BBB plus. Now, our bond, we don't have sovereign bond, but let's say State Bank bond or Reliance bond. Our bond versus a sovereign bond of Italy, there is a delta of 300 basis point plus, which means if we go up one notch above, the cost of borrowing is going to come down significantly. And if that happens, it will have a lot of big positive impact on the Indian corporates. And I think that's what we are really aiming for, to reduce the cost of capital overall by improving the financials of the country. One of the statements which the finance minister made is that not only on the gliding path of the fiscal deficit, but also she said that we are committed to keep the debt to GDP ratio constant going forward, which is actually quite a positive statement. So that should actually keep the investment climate on for the long term.
Okay. Thank you so much. I would, of course, tempted to ask you on the market reaction, but I'll hold my thought on that. I'll come back to you on that. Dr. Shukla and others, if you know, maybe if we take up from what Sunilji has mentioned, do you think that we have now made a case for a rating upgrade? And also from the yeah, maybe that would be a first immediate thought. Is there a case for that, do you think, Dr. Shukla?
So I think let me first bring in the backdrop, which is very important, and then I'll come to the ratings part. I think this was the first budget of the NDA government. I mean, it's the NDA government, but there has been a change in the electoral mandate. And this was, in fact, the first coalition budget, right? So earlier it was one party, and therefore the budget was essentially seen as their point of view. This time there was some trepidation, some fears in terms of some bit of populism seeping through. I think what this budget has done via the focus on fiscal prudence and fiscal discipline, fiscal marksmanship, is that they have allayed this fear of a exaggerated pivot towards populism. Before the budget, we had seen certain state governments announce some moves which were seen as populist, and therefore there were these fears at the back of the minds of people that this might also probably pivot or turn a bit more towards populism. Now, the proof is in the pudding, right? So, for example, as compared to the interim budget numbers, I'll just give you one anecdote or one data point. The revenue numbers have gone up by almost, say, 1,30,000 crore, thanks largely to the RBI's dividend, you can call
I
it
think
the
the
hand of God.
budgeted total revenue, I think, is substantially increased from 1.28 trillion to 31 point.
Yeah, I'm saying just from the interim budget numbers, right? Incremental revenue number. Your revenue has gone up by close to 1,30,000 crore. Incremental spending. So how have they used that bonanza, right? Only 55,000 crore has gone into revenue expenditure. So if you compare from the interim budget to now, the expenditure number has gone up by around 55,000 crore. The rest, roughly 70 plus thousand crore, has gone in to shrink the fiscal deficit even more aggressively. So from 5.1, which we saw, and we are talking, we are making this comparison from just February onwards, right? So that shows the commitment to fiscal deficit. I think we need to be doing this continuously. So think of what the government has done. Almost 90 basis points in just 12 months flat, right? The fiscal deficit has shrunk by that much. Again, if you look at the revenue deficit, which basically tells you how productively you're using your borrowings, right? That has shrunk by 100 basis points. And I think the primary deficit is down 70 basis points. But having said all of this, so if you think about the post-pandemic peak of 9.2 for fiscal deficit, and then going down all the way to 4.9, it is commendable. So whether you compare it with the last 12 months or post-pandemic, it is commendable. But it is not enough. I think we'll need to do more. We will have to look at the fiscal targets, the FRBM targets, and also the debt to GDP ratios, right? I think that is the crux. And all this talk about, say, the rating agencies really giving India a tough time. I think we need to also understand that when you look at the general government debt, uh, so if I look at the cohort of 137 countries rated by S&P, India ranks 120th, right? And in the triple B minus rated cohort, the average net general government debt is at around 38 or 40% as a percentage of GDP in 2023, which is less than half of what India has, right? We are 80 plus. And only Greece within this triple B minus category has a higher general government debt than India at 143% of GDP. But please remember that Greece has a per capita income of more than $22,000 in 2023. So I think we must compliment the government for really having adhered to the fiscal prudence path. The marksmanship has improved dramatically. But let's not lose sight of the fact that in terms of our ranking when it comes to general government debt, when I say general government debt, I mean the center and the states together. We must not lose sight of the fact that we're still not there. And therefore, we will have a lot of work to do before we can even think of getting a ratings upgrade. Back to you.
Okay. Rajniji, if you can perhaps share your thought. I don't know. I think the message which I got was that we still have some distance to cover for the rating upgrade. But based on what you see, is the consumption story likely to take off? Is the employment generation, the economic survey talked of 78.5 lakh jobs that we need annually. Does this kind of the concoction which has now emerged out of this, does this kind of give us the feeling that we will be hitting those kind of numbers? And since this budget is now for the next 6 months, in another 6 months, we will have another budget. What is the impression you get there?
So, Kumar, I'll talk a little about India rating upgrade expectation, and then I'll move on to the budget.
Yes, thanks.
So, like Sachidanand very rightly pointed out, the positive aspect is that India's fiscal deficit is reducing, which is a big positive. But if we look at our debt to GDP ratio, it's still, like Sachidanand highlighted, it's still high at around 82%. But the more important point to note is that we have economies, other developed economies, which have much higher debt to GDP than India. Say US, UK, Japan, they have much higher debt to GDP. But the important point is that their interest payment, their interest payment requirement is much less than ours. So if we look at our interest payment as a percentage of our total revenue, government revenue, it's as high as around 32 to 34%. Whereas for many of these economies, developed economies, because of lower interest rate, even with the very high government debt that they have, their interest payment commitment is much lower. In fact, now it's a concern for them because interest rates have gone up in these developed economies, and they're expected to remain higher for longer. So now they will feel, they're worried about the very high government debt, and they will feel the pinch of higher interest payment commitment that they'll have. But there's a big difference in terms of 30 to 34% of our total revenue that we are paying, as against much lesser, less than 10%, which many of these developed economies are paying. So in that sense, we have a long way to go in terms of reducing our government debt before we look at a rating upgrade. But definitely, fiscal consolidation is a positive thing to note. Now, when I talk about the budget, one thing I would like to highlight is that this budget, as we have seen in the last few years also, has kind of focused on the long-term growth story. There's no immediate, any measure to give money in the hands of people. No significant strong measures. There has been a little tinkering of income tax slabs for the new tax regime, but very small things, or direct benefit transfer for the new employees. But otherwise, if you see, there's no big way in which money has been given in the hands of people to propel consumption. And like you said, that was a big ask right now because consumption in the economy has been weak. But I would say, in fact, the route that the government has taken is a more long-term and sustainable route, which is, focusing on other aspects like employment generation, infrastructure, urban development, supporting MSMEs, supporting tourism sector. These aspects would indirectly lead to increased consumption and investment, which should help in sustaining India's growth momentum. And all this has been done while moving towards fiscal consolidation. So I would say it's a good balanced budget looking at the long-term perspective rather than more of near-term impact.
Yeah. No, I think very succinctly put, actually. Thanks so much, Rajniji. Now, Mr. Indranil, if, given one curious element which does come up, and we had a conference recently of the summit where the RBI governor spoke and he talked of the deposit mobilization challenge. Does this, since the FICCI has also called it as an inclusive budget, how do you see the journey towards an inclusive credit environment? Does this give you confidence in that direction?
Well, I think a few things that I'm not sure where data is available. So some time back, I was trying to figure out one particular reason why rural consumption may be low is not because of the income that is getting generated or the very thought process that if monsoons are better, there will be a better sort of cropping, and therefore incomes will grow up, and therefore rural consumption will immediately come back on stream. I think the issue somewhere is, and this is something that I think the budgets generally tend to miss out, is that we still possibly carry, even as the economic survey says, that we are 20% higher than the pre-COVID levels. Yes, we are, but let us not forget that the exit rate pre-COVID was just around the 3.9% GDP growth in that particular quarter. So rather than sort of sitting and patting our backs that we are 20% higher than the pre-COVID level, the point that we are missing out is that whether there is still a deadweight loss from the COVID, in the sense that a lot of people who might have actually lost jobs during COVID, even if they have been employed in an alternative job, the rate of income generation for that particular individual may still be lower than in the pre-COVID era. And that's what is also possibly leading to the huge amount of inequality in the system. So I think before we sort of talk about deposits, savings, etc., I think we need to understand the indebtedness of the Indian economy from the perspective of the lower income brackets that we talk about. And here, the data that I would allude to is from the Financial Stability Report of the Reserve Bank of India, whereby they say that there is a reduction in the stress factor from the personal loans, probably also due to the fact that there is a risk weightage increase in these loans. But the two red flags that they still call out is, especially for example, the private sector banks. The growth in the unsecured loan of the private sector banks is actually coming down. But the delta in terms of the NPAs of the private sector bank in that area is still going up. So that's one red flag that the RBI has called out. The other important thing that they've called out is for loan sizes, ticket sizes less than 50,000 rupees, a person who is taking a loan today has three continuing loans in his name. So this is the fourth loan that he is taking. So we don't really have an answer whether there is evergreening that is happening from one loan to the other, which necessarily leads to a discussion of the stress levels that continue to be there in the lower income bracket and especially the rural economy. So any delta in terms of income in the hands of this lower income and the stressed portion of the economy, including the rural segment, will possibly now be going for repayment of these loans rather than additional consumption. If you look at it from that perspective, it is no doubt that the deposits is actually going down. Now, here, I think the other clarification that needs to also be made is that the money that is getting collected by the mutual funds, etc., ultimately comes to the banking sources. Now, the overall deposits may not be going down, but the deposits from the household sector, which is therefore by definition the stress sector, that is actually going down. So to a certain extent, again, coming back to what probably Sachidanand said and Rajni was also alluding to, in terms of the journey that we still need to cover. Just before this panel, I was looking at some of the data. The last data that I got from the World Bank is India's per capita income is about 2730 in dollar terms, whereas Indonesia is 5270 and Thailand is 7810. India's contribution in terms of the global GDP or the global value added is just about 3.6%. Its trade is 1.8%. So in these conditions, and the finance minister's objective of keeping debt at constant levels, I would have expected her to say that we will aspire to reduce the debt back to the pre-COVID levels, which was 73 and 74%. It doesn't make a difference to me whether the debt level is at 82% or an 83%, or it has just come down from an 85% to an 82%. So these are some of the factors I think will be deterrent to any upgrade immediately. The last point that I want to make is that we all tom-tom about the center's deficit. But if you actually look at the overall sort of communication that has come from the rating agencies, it is the state and the center together. Now, every year we see the states targeting a 2.8%, but ultimately they land up, the good states taken together land up at about 3.1%. And taking all the other 9 states which are fiscally challenged, it lands at about 3.3%. So the whole fiscal federalism, in my opinion, has moved in a direction whereby states, in terms of their revenue collection mechanism, is challenged. I don't know why the government is collecting the cess on the sin tax on the GST and is not passing it on and is therefore using it for their own budget. They should actually sort of stop doing this, and then the general public will anyways get a delta in terms of the consumption power, because we still talk about the discretionary consumption, which is actually driving the economy. So from that perspective, this is another sort of very significant thought process that I have in terms of even the long-term journey for India. Now, we tend to talk about the fiscal deficit as a proportion of GDP, which obviously, because the denominator goes up, will come down. No worries about that. Last year, we had a bumper 8.1% GDP, while your GVA is still at 6.9%. So obviously the base has become quite lucrative along with the other beneficial effects on the revenue side. Now, if I just put, say, a 10.5% GDP number for the next year, so 25 to 26, where I'm sort of trying to bring into focus the 4.5% that is the promise by the finance minister. It's no rocket science that she'll achieve it. If I put a 10.5% growth from a 326 trillion, my GDP goes up to a 360 trillion. On that, if I calculate a 4.5%, the absolute fiscal deficit turns out to be 6.21 trillion compared to the 6.13 trillion. And therefore, you can't bring your debt down. And associated with the point that Rajni made, the interest payment bill is quite significant at around 3.6% of GDP. So there I rest my point that I'm not sure whether we are doing the right thing just by focusing on 4.5% and talking of fiscal consolidation, and missing the actual pain points in the economy. And therefore, the journey for India remains even more onerous from here on, rather than the environment that the government wants to create towards the Viksit Bharat.
Thank you so much. In fact, I think what you touched upon is very fundamental and core to our thinking. In fact, if that can be considered, I think then these numbers will get sorted out in any case, actually. So thanks so much for that. Now to Dr. Shukla and others, actually, anyone can pitch in. My thought is, since many of the viewers here would be from the corporate world, my question is, in terms of now that the government is saying that the baton is passed on to the private sector on capital expenditure, that is what you need to do. What do you see as the way, as the strategy towards, pitching in that front? What ingredients do you see in the budget that can incentivize them to look at capital expenditure, the private sector? If you can begin with, we can begin with Dr. Shukla.
Thank you again. I think the very first thing is the continued focus on capital expenditure, right? It's been a while, and the government has been doing the heavy lifting. But I think what that has done is that it has given a fillip to, say, capex activity at a time when the global macro and the global geopolitics is undergoing enormous structural changes, right? So we're trying to move towards decarbonization. Demographics is a challenge. And then there are tech changes, tectonic tech changes, right? Gen AI and things like that.
So do you see this this budget actually, in some sense, sorry, maybe I've not conveyed, do you think that the budget has something in it which can incentivize the industry to look in terms of capital expenditure now?
So absolutely, that's the point I'm trying to address. By reiterating its commitment to capital expenditure-led growth strategy, right? And then going back to the opening comments that I made, I mean, there was this thing at the back of minds of the people that maybe they will do some sort of a pivot and they will prioritize consumption over capital expenditure. But if you think about it, the numbers have remained unchanged at 11.1 lakh crore, right? That is reiteration of your commitment towards the strategy that you have really taken forward. With that, now they're trying to bring in a key issue, key bugbear of the industry, which is the employment and the income part. So in a way, they have also tried to address the consumption piece. So if you are able to bring in to develop a pool of employable people, so the missing thing was employment and employability, right? And any industry leader you speak to, so despite being a labor surplus economy, everybody would crib that we're not getting the right sort of people and all of that. And there are multiple schemes. I will not go into the details, but essentially what you're trying to do is the government is putting money where its mouth is. So you are trying to give, say, 15,000 rupees, plus you're trying to skill people. You're also trying to formalize by giving that 3,000 rupees for EPFO and all of that. If you do that, you are addressing a challenge that has bogged the industry. So, you are maintaining your commitment to capex, public capex-led, say, growth. Second, you're trying to give some fillip to consumption via this employment thing, which has been a big problem, and which is what I think indirectly Indranil also has been alluding to. If you do that, capacity utilization levels move up over time. Obviously, this is not a 1 year or a 1 quarter thing. It will take some time, but it will provide a fillip, and therefore capacity utilization levels go up. It stagnated, I mean, on an average, around the 73, 74 levels. Yes, there are sectors where it is much higher, but on an average, it needs to move up to that 80 odd level. And I think over time, this will lead to that. The other issue, I think, is the cost of capital. And again, by showing the commitment towards fiscal discipline, lower borrowing, etc., there is some cap on that interest rate uh, borrowing cost for corporates, despite the higher for longer commentary coming out from the larger central banks, or even here. I mean, interest rates have remained very high for very long. If you think about it, the price that the economy is paying, if you think of the 170 lakh crore kind of credit number, just the industry is going to be paying about 70,000 crore more in terms of interest outgo, because your interest rates have gone up by almost, say, 200 basis. Housing, for example, will be paying, people all put together will be paying about 56,000 crore higher in terms of interest outgo. People who borrowed for automobiles will be paying nearly 13,000 crore extra. So I think there is a price that was being paid, and if you're trying to do all of these things together, it will nudge the corporate sector in terms of doing what they should be doing. Only one factor, which is the global environment. I mean, when there is this carbon tax being imposed in Europe, and then people are looking at multiple such things, there is a bit of confusion over the long-term regulatory trajectory. And if we have to move towards that future, the greener future, I do not know how some entrepreneur or some corporate will try to put in big money in some large capex. The erstwhile industries, I mean, these are all oil and gas and metals and all of these commodities, right? If you have this kind of uncertainty at the geopolitical level and regulatory, I mean, lack of regulatory clarity, you would not want to commit big funds this point in time.
Wow, I think a very important point. I think the way you articulated, I think it's important that we keep this in mind, especially when we want to be the factory for the world and all of that, and that will require capital expenditure in some of these areas where actually regulatory challenges could be there from an environment point of view.
May I make a small comment, please?
Yeah, please.
See, I would like to focus on one is the manufacturing being encouraged by the government.
I'm coming to that, yeah.
And the public private partnership, which was spoken of, and the foreign investment being attracted. So I think all these things put together may definitely improve the situation of capital outlay in the country. Thank you.
Yeah, I think all the three aspects, I think if, maybe, if Rajni ji, you have a thought on this, or Mr. Niyar, Mr. Sunil, you can, maybe if you can start with Rajni. This point which is there about manufacturing, I mean, we need to move towards, beyond being the 16% of GDP and all of that. What's your take on this? You're on mute.
So, like I mentioned earlier, in the budget, as such, again, even for manufacturing, there's no direct measure as such which is going to immediately boost manufacturing sector. But there are indirect ways in which the sector is being supported. One important thing is that for manufacturing sector, the reason why we're looking at manufacturing sector and we want the share of manufacturing sector to grow is because we feel that it will be able to absorb a large pool of India's working age population, the workforce, large workforce that we have, and we do not have adequate jobs for that. So in that sense, the budget has taken care of all the, employment incentive schemes that are there. So there have been schemes announced to encourage job creation, both for the employees as well as for the employers. And at the same time, they have continued the focus on skilling, because that's a very important aspect. Even if there are jobs, do we have people adequately skilled to be absorbed in the workforce? So, if you see in the budget, again, the focus on skilling has continued. This internship scheme that has been announced with top 500 companies for 12 months, I think all these are steps in the right direction, and that should help in skilling the people adequately. So I feel that there are different ways. Again, if they are supporting all the schemes that have been announced for supporting the MSME segments, that's again an important part. When we look at manufacturing sector, we also have to look at what is being done to support growth in smaller companies, smaller manufacturing units. So the budget has focused on that aspect also as required. But when it comes to and again, another very important aspect, if we want to increase the share of manufacturing sector, is what is happening to physical infrastructure. Because if we are looking at, like you said, we are looking at making India the global manufacturing hub. If we are looking at something like that, we have to look at reducing the logistics cost. We have to look at improving overall the physical infrastructure. And in that regard, I feel a lot is being done. But all these are things which are going to take time. We may not see the impact immediately, but if we are looking at competing with China, if we are looking at attracting FDI, it will be very important as to what we do in terms of improving the infrastructure. So that is happening. The other important thing would be, I think, land and labor reforms. That's something which needs to be looked at. Ease of doing business, which needs to be further improved. So I think those are the other important pieces which needs to be worked on to ensure that we are able to increase the share of manufacturing sector.
Absolutely, I think very important. Though I think I was looking in terms of a big ticket mention, because that is what I mean. We have, this is in some sense again an interim budget, because another 6 months we have another budget. But from the point of view of making a big ticket impact, I mean, we had the budget talk about Bihar and Andhra Pradesh also. And fortunately, as you rightly pointed out, even there the focus is on infrastructure and on building in ports and irrigation projects and all of that. So what would be your thought, Mr. Sunil and Mr. Nihar? You haven't shared your thoughts on this.
So if I can come on the corporate investment and the manufacturing, the point which you made, I think this is a Triveni, a combination of three things. One, as you just heard, that the capex cycle continues, 11.11 lakh crore, that continues. And if you see, this is in continuation of the last 2 years, and this is the third year. And we all know it takes time, but it has its own impact, plus the state investment, all put together around 15 odd lakhs crores. So eventually the private sector will follow along with the government. And that's where the question came up on PPP. So that's definitely going to happen. The second part is that this budget very cleverly refocuses. We talked about the hard infrastructure so far, road, port, airport, railways. This time, the focus has been more education, skilling, the soft infrastructure, the bridging the gap. The point came up, the corporates have been asking for the skilled people, and the people have been demanding job. So he said, go out and skill. I mean, there are the people who are looking for the job, and he's a corporate who are wanting to employ. Give them 1 year internship and then just try and absorb them, because this is what is going to happen. We do this in our organization all the time. So this is a bridging the gap very cleverly. In the same vein, rural, let's say land reform. Land reform is not easy, is a bad word, but the way it has been structured is digitization of the land record is nothing but the land reform ultimately, because that's where you will have the supply of the land, urban housing and the rural housing. So that's the second part of the Triveni. The third part of the Triveni is the whole financing package. Rather than giving DBT, direct money in the hands of either the farmer or subsidize the fertilizer, or there is a credit guarantee scheme which worked during COVID very, very well. And that would provide the financing to MSME and other manufacturing sector, plus a robust capital market. Ultimately, the capital market allows the equity funding which we are looking for. So you have equity, you have debt coming through the credit guarantee scheme, you have a government support coming through the capex, and you have all the softer aspect taken care of. So this combination of Triveni is eventually going to lead us to boosting the investment in the economy through the manufacturing.
Okay.
I just want to quickly touch on one point which came up and got lost somewhere on FDI. So the two important changes on FDI, one is for the foreign corporates operating in India, the tax rate down from 40% to 35%. This was a demand because they said we should be treated as par with the Indian corporates. And so we haven't gone down to that level, but 40 to 35. And you would realize that a lot of these foreign corporates, they are sitting with a lot of cash. So rather than taking the cash back home by way of a dividend, they can redeploy with the lower tax rate, and they can redeploy that for setting up their own manufacturing and etc. Plus FDI, there are number of cases, and we are dealing with them. So therefore, I know where foreign corporates are looking at India to set up the manufacturing facility, either on their own or through the JV partners.
Even GCCs, I think the way they are investing.
GCC is good. Yep, absolutely. That's really a big area in terms of the job creation, particularly.
Exactly. Yeah. Mr. Nihar, one thing which I do want to touch upon is anything in terms of innovativeness that you saw in the budget. Like, for example, take the case of agriculture. They could have just increased the allocation in terms of research, but they've opted for the challenge fund route, for example, to incentivize research. Did you, when you saw through the budget, do you find anything, some innovative examples of how they have approached things?
See, particularly, I think this time the focus on MSMEs and particularly this credit guarantee scheme which they are bringing in, which actually was first introduced at the time of COVID to help MSMEs. This is, I think, a newer idea because most of the banks and NBFCs are very averse to financing MSMEs, even if they want to go for manufacturing. So this credit guarantee scheme will really boost the bank's attitude and NBFC's attitude to finance MSMEs. Another very important thing is like when you talk of increasing the manufacturing activity, I think it will have to be coupled with the green movement also, because the pollution that the industry would create, government will have to see. And there we don't see any action so far, although government is every time repeating that their focus will be on green movement, but it is required to be accelerated the way the weather is changing and the events are happening. Secondly, in skill development, particularly what I have seen is even with new education policy, that most of the efforts of educational institutions are towards skilling the students and the youngsters in service sector, in IT, but there should be equal skill development in the area of manufacturing, where new technologies, automation, with all that, I think the efforts are less. So probably in the 6 months when the new budget comes, perhaps focus will be given to that. But most appreciated innovation is this credit guarantee that will certainly boost MSMEs. One more step which they can take is that interest rates have gone up like anything. Big industries can afford, but for MSMEs, this kind of rate of interest is really unaffordable. And there they should do something to incentivize them.
Yeah, I'm sure many listening to you will empathize with that. Actually, a very, very important point. Yes, on the training part and skilling, very important. Even in the sustainability environment space, when I talk to companies, they have the problem in terms of how do we have the talent who can actually help us in that. So I think it's a huge area. The last point, I think we are running out of time as I look at the clock. Deepak, if there are any questions that you think from the audience we need to add, we can maybe push in one or two questions. Otherwise, I have my first question, which I wanted to ask Mr. Sunil and everyone else in terms of a quick thought on the market reaction. Why is the market like this?
So just quickly on the market, obviously the market likes something which is immediate and the short term. We didn't like the capital gain. We didn't like the whole change in the capital gain, though it was something which was expected, right? I won't say that last two budget this has been talked about, that there is going to be a rationalization in the capital gain. I guess anything retrospective is not appropriate. If this would have been with a sunset clause and said, look, prospective rather than retrospective. So if the grandfathering which they did earlier, that would have been a better, and that would have been a positive for the market. 2.5% is not really that much big deterrent. It's the way it has happened is it's without grandfathering is the wrong thing to do. That's what his market is not liked.
Yeah, thanks so much. Deepak, over to you.
So one of the question, I think it's maybe Mr. Jambusarya can answer is that is the benefit of indexation available if the asset was acquired before 1/4/2001, along with benefit of opting FMVs and 1/4/2001. So any thought on this? I think indexation issue has been cropping up a lot after the announcement.
See, yeah, they will still continue to get FMV on 2001, but indexation will not be allowed because subsection 2 of section 48 is being completely omitted now. It is being abolished. So indexation benefit will not be available.
Yeah.
Only this replacement of fair value will be available as on 1st April 2001.
Ujjwala ji, you have any question? You have been silent.
No, I would just leave the question to the viewers. Yeah. Deepak, you can take any more.
Yeah, I'm just reading through some of the questions. I think some of the part on skilling has been covered. I'm not sure if anyone can answer here on the question of any benefits are given in the budget related to port or port-led industrialization and special economic zones. So that is something I'm not sure whether any of that announcement was made.
That
Any
was there in the
incentives?
interim, Deepak.
Yeah.
It was there in the
Sorry.
interim budget.
Okay.
It was there.
Something on duty, we can say, or custom duties also, there will be a lot of changes.
Any encouragement or incentive towards improvement of ESG initiative and results rather than only penalty on defaulters? Anything you guys are aware of on the ESG side?
No, this is scheme of solar scheme, a rooftop solar scheme that got a big fillip. So
yeah, we can talk on
the
that. I
ESG
think
side.
that's
Yeah.
a good
Move to Bijli.
point of discussion here. The solar panels.
Yeah, that's true. One question which I do get, I think it looks like a general individual interest question, is that can individuals, I think it's possible, I think, can individuals switch from old tax regime to new and then go back to old? I think that's possible, isn't it?
That is possible, but once the individual goes back to old regime, then he will not be able to come back to new regime. So it will be allowed. You adopt new regime today. Suppose next year you want to go back to old regime, you can go back, but then the permission to come back to new regime is not there.
I see. Then you can't. Okay, I see. So only once it's possible, even for individuals. I see.
Yeah.
Okay, thanks so much. So Deepak, are we?
Yeah, so I think some of them are comments. I'm not able to take them as question out here. But yeah, in the question format, these were the questions I had. So that's it.
I have also a long list of questions, but time is always a constraint.
Correct. So that's fine. So maybe any last word from each of the panelists, and we can then close it.
Yeah, some concluding remarks, perhaps your one-line takeaways in terms of, rather than just the nice wording of picky or balanced budget or something, give us one positive and one concern. Each perhaps maybe that may be a nice way to conclude, hopefully. Maybe we can start with Rajni ji.
I would say the positive that they have continued fiscal consolidation and focused on sustaining the growth. I think the negative is that at this point, in the near term, we need to worry about the weak consumption. So in the near term, how will that flip come? All this indirectly, it is going to happen, but that's going to take time.
Okay. Mr. Indraneet.
So one positive, I think Mr. Nihar had already pointed out, it's the inclusion of the MSMEs in the credit guarantee. We did see a very significant jump in the credit to the MSMEs post-COVID. But a worry over here is that we need to monitor end use of funds very carefully, because post-COVID, it was more to do with stabilizing and keeping that MSME afloat. That is something that we are not looking at this point in time. So that's, but having said that, the inclusion of the MSME in the discussion on an explicit way and bringing the credit-linked guarantee scheme back is positive for me. The negative, I think, I still am challenged to think about implementation in most of the areas, more in terms of the employment-linked incentive schemes. Now, if we are talking about just 500 companies, and they are relatively larger companies, and they are still capital heavy companies, absorption of, you can train them for a year, but absorption will become a difficult issue. And that's, I think, needs to be monitored very carefully. And if I am maybe allowed, in terms of another sort of negative that I think is present in the budget, is possibly there is not much thought going to education yet. Now we are talking about IITs and manifestations of IIMs and etc., etc. But we should talk about the significantly high dropout rates from the primary education to the secondary education, which means that if this sort of a population or youth goes ahead, we will still be talking about low value added jobs and not higher value added jobs. So that will be an impediment to growth.
We need to incentivize faculty there and all of that.
Yeah. So that,
Niharji, one positive and one worry.
Yeah, one positive is the steps on solar, which is going to really boost the climate change initiative of the government, because pollution will be within control if solar initiative is boosted in the future. And one negative is still in our country, there is very less focus on ease of doing. Although we talk about ease of doing so much, but really, if we want to give a constructive idea to the government, see the certainty in interpretation of tax laws, one example. Second, incorporation of a company by a non-resident here, which still takes a very long time. Whereas in countries like Singapore and other advanced countries, it takes less than a week. So if we focus more on ease of doing, the foreign capital which is waiting for investment in India, but for ease of doing question mark, they are still thinking twice or thrice. I think they will come to India faster than what they think about India today. So that is one.
Dr. Shukla, and then Mr. Sunil.
I think I would say that the reiteration of commitment to capex-led growth and complementing it with softer infrastructure, right? So they've announced a lot of things. They've taken the biggest challenge head on, which is jobs. So they've tried to address it through a roadmap. I mean, it's a medium-term thing. Obviously, the negative is going to be how does it get implemented or executed? I think that remains the holy grail.
Always, it's always the case in every budget. Sunilji, your concluding.
Two quick points on in terms of the positive. I think this could have been a lot different given the political mandate and the outcome of the election. We all thought that it will be a consumption-led budget, but they've been very thoughtful in terms of how they're weaving around some of the supports which will ultimately lead to the consumption. So that was a creative way of doing it. On work in progress, this budget looks to me as more work in progress. A lot of initiatives, suggestions you said, they are going to come back, but they didn't get enough time really to work on, including the taxation and all, which is where the compliance issues are coming up, I think. So there is a work in progress. Hopefully by next or between interim from now to the next budget, they will come up with more policy announcements.
Yeah, the work in progress. Very nice way to actually see that in 6 months we have another budget. Deepak, from a journalist perspective, this was journalist delight actually to have a panel like this. Incredible speakers. Thank you so very much. Deepak, any thoughts?
No, thank you very much. I think, yeah, they have been very actively supporting us, all of them, members of our chief economist, forum, co-chaired by Dr. Shukla and Rajni ji, and Mr. Pan has always been there, to support us. So thank you very much to all of them. Thanks to Mr. Jambusaria also for, taking, I know tax professionals are the most maybe busy, and the economists as well, the most busy people for these 24 48 hours and most demanded, and you too, because you are so busy in covering the financial express part. So thank you very much for taking time out on a short notice. And Mr. Sangai is the biggest Sherpa of Fiki sitting here. Thank you very much, Sunil ji, for spending your time with us today and giving us view on the capital market. I understand this is there's so many things in this budget which one could cover, but unfortunately we framed it in a way that we just could get 90 minutes to cover whatever best we can. But people can always share their comments on email with us, and then wherever we can feed in as FICCI to government on the reform side, we'll be happy to do that. And we'll also obviously do a snippets of this particular discussion also. So once again, thank you very much on behalf of all our, member of the State Council. Ujjwala ji is the co-chair. So thank you, for supporting us and being here and doing this wonderful discussion, quite enriching one. And I'm sure this would be the same, thought of our all participant as well. So once again, thank you and have a good day.
Thank you so much.
Thank you very much. Thanks. Bye.
Thank you so very much. Bye.